welcome everyone to the second event of the Solana Wormhole Hackathon. Today we are doing a DeFi recap where we're going to do an analysis of the recent DeFi boom and a look into the next future and wave of DeFi. We have an absolutely incredible panel for you all today. We have Stani, who is the founder of Aave. We have Tarun, who is the CEO and founder of Gauntle. We have Jeremy, who is head of growth from Balancer. Michael, who is the founder and CEO of Curve. Anatoly, who is the CEO and co-founder of Solana. And then we have Sam Bankman-Fried, who is the CEO and founder of Alameda Research and FTX, who will be taking my spot in just a moment. I appreciate you all tuning in. It's going to be about an hour-long conversation. And just a few quick recaps. We have a chat section, which I see a lot of folks are already making use of, and we also have a questions tab. So throughout the panel, just kind of post your questions in there, and we'll spend the last 10 or 15 minutes answering them all for y'all. You can upvote questions in the tab, and we'll probably take the top 5 to not take up too much time. So once again, thank you all for the panelists for joining us, and have fun. I'm gonna jump off stage now, and I'll bring Sam on. Totally, it's all you.
Awesome. Hey folks, normally we'd be grabbing a beer at a bar somewhere at a conference, but looks like we get to do this over Zoom this time. But really cool to see everyone again. So we had a kind of a crazy summer, I would say. We launched 3 days after the Black Swan of in March, and we thought the world was going to fall apart, and turns out it didn't. Turns out actually a lot of cool stuff was folks have been building a lot of really cool stuff in the background, and I couldn't have even predicted a perfect opportunity to try all this stuff, because all of a sudden you had a million of the most innovative and intelligent people all stuck at home looking for something to do interesting in crypto. And I think to me that was a big part of it. I kind of want to give you guys a chance to introduce yourselves and kind of briefly mention what you're working on and what you see DeFi coming out of this boom into I think how do you see the space maturing? So I'm going to go down the list of you folks as it looks like on my screen, which could be different. So I'll start with Jeremy first.
Sure. Thanks, Anatoly. My name is Jeremy Musighi. I'm the head of growth at Balancer Labs. I support the community-driven expansion of the Balancer protocol. Previously founded and sold 2 tech companies. I've been a crypto investor and researcher since 2013. And a little about Balancer. It's a generalized AMM protocol, which serves as a building block for DeFi and powers a lot of different types of applications, including a decentralized exchange, index funds that are managed or automated, fair and transparent IDO, token sales, and smart treasuries, and a lot more.
Awesome. Yeah, really cool. Really good to have you. And Michael, Egorov, do you want to kind of introduce yourselves real
yeah,
quick?
Sure. Yes, Michael, founder of Curve, and Curve started in January this year, and worked without any token before August, and now we have a DAO, and it's fully decentralized, and looks like it got right in time with all the DeFi boom and all the demand for on-chain liquidity. And that obviously applies to Balancer too, right?
So briefly, just if folks don't know, Curve is primarily focused for stable coins, right? And Balancer is kind of baskets of random things.
Exactly.
Right? And to me, it's been cool to see how you go from a very simple concept of an AMM and now how things are fracturing and specializing, and that there's just a ton of innovation happening, kind of going into the specialization side. So Stani, if I pronounced your name correctly, can you introduce yourself and Aave?
Sure. So I'm Stani. I'm the founder and CEO of Aave. Aave is a team that contributes to the Aave protocol, which is a decentralized money market protocol. Practically, the idea is to have for cryptographic assets on-chain interest rate in transparent, permissionless fashion. And I've been hustling this DeFi thing for a few years now. Before Aave, we used to be called ETHLend, which is short for Ethereum lending. That was the first on-chain lending protocol. And I think this year, as we launched in January, it has been very amazing year for us. Mostly because we finally see like a good amount of ecosystem activity compared to what it used to be a couple of years ago. And for us, it has been pretty nice traction so far. And in terms of functionality, how our protocol is interesting is that all the liquidity that's in the smart contracts that isn't borrowed out can be used to flash borrow. So you can take a flash loan for one Ethereum transaction and do all kinds of things and then return the flash loan as well. So that's kind of our thing. And now we're focusing on our version 2 and getting the whole protocol more decentralized.
That's super cool. Like, flash loans are one of those things that kind of like mentally blew me away as folks both thought as like a bug, but I always like immediately saw it as like almost like garbage collection, like you do in like Java or something like that, but for finance. It just seems like a beautiful like construct to be able to like do this like atomic thing within like a financial system. It's pretty cool stuff. And like actually Tarun is next in my like screen. Him and I had like a podcast where we argued about the stuff, mostly in agreement. So like, I don't know, do you want to introduce yourself?
Hey, yeah, I'm Tarun. I'm the founder and CEO of Gauntle. We basically do economic stress testing and governance participation in DeFi protocols. And we're working on a system to help sort of automate a lot of quantitative decisions people have to do, generating recommendations and making it so that, you know, you don't have to understand what, you know, the analog of LIBOR is in Aave or Compound or you know, what type of portfolio you're holding in Curve when you're an LP. Yeah, and I guess I've been kind of in the space in a bunch of different ways for a while, and I think it's been interesting to see the financialization narrative, you know, finally come true after a few years of kind of watching proof of stake kind of almost get to this level of hyper financialization and then miss it sort of recently.
Cool. Awesome. Yeah. And like, I think the last person on the list, Sam, brief intro.
Yeah. My name is Sam. I'm the CEO and co-founder of Alameda Research and FTX. And I've also been spearheading Project Serum. And I mean, whatever, there's a lot going on. And I tweet about it like too many times a day. So probably this is just repetitive for most people. But I don't know, I guess sort of like, you know, newest things coming out here is, you know, from a high level, I think on the Serum side, we sort of see the order books as like the most impressive and powerful thing that we could release, and probably single most useful thing and most powerful proof of concept. But it's not a decentralized ecosystem in and of itself. It's one dApp. I think it's the way we think about it. But Serum is sort of meant to be way more than one dApp, and I think composability is a huge piece of that. And so I think what we're looking at over the next month is a ton of other dApps coming out. on Solana, all composing within the Serum ecosystem, which I think will sort of take it from like the best DEX to a fully fledged, decentralized ecosystem.
Awesome. So like I'll kind of give a brief intro. If folks who don't know who I am, you're in the Solana hackathon. I hope you know that I'm the co-founder CEO, and Solana is like the weird thing about like the project is when I started it, I had this idea that we're going to decentralize NASDAQ, and I was literally like kind of pounding the table that these systems are places for traders to connect and figure out a price on something and do it in the most fastest, like low latency, open way possible. And it was really hard for, I think, folks to kind of get that vision until like this DeFi boom happened. And then I kind of think in retrospect, it's obvious that almost like Ethereum is like an exchange where price discovery occurs through AMMs and other protocols. And now Solana was designed for this idea of a club style price discovery, which is a bit more throughput intensive. And I'm excited to see, like, I think both of these worlds combine. Do you guys, like, from your perspective and how you're building your financial instruments, do you see layer ones as separate ecosystems, all part of the same ecosystem? Is it like Android versus iOS, where you're going to end up building on both? Or is it more like, Solana is, like Binance and Ethereum is Huobi, and you're like plugged in on Huobi right now, and then eventually you'll move over to another one simply because this is where money moves? Like, what do you guys kind of see like layer ones as from your point of view?
I think from the point of view of a project like a DEX, like Balancer, I think it makes sense for a decentralized project to have a home on a particular layer one, but I also think there's there can be a lot of value to bridging and connecting and interoperating with other layer ones. I think that one of the big challenges with expanding or building your protocol on other blockchains, like if you're an Ethereum-based project, for example, is that it's really hard to manage a project that lives on multiple chains. It's not 2 times as hard to be on two chains. It might be 4 times as hard or something like that. So I think there are definitely pros and cons.
Yeah, kid number 3 is the easiest because you've already like established some scale into like dealing with kids. But I could see the second one is kind of the hardest typically. Like Michael, what are your thoughts?
Yeah, I mean, it's usually very hard for like a different layer 1 chain to take off, because I think that network effects of layer 1 are the strongest. And although Ethereum is super slow compared to some other chains like Solana, it's still like everything lives on Ethereum. Of course, it's very secure. That's good, but yeah, the speed is not really great. And it would be nice to see like to see maybe either other chains being used as instead of layer 2, or maybe layer 2 solutions. But for that to happen, I guess one needs exactly the same form of smart contracts being executable there. So like you don't have to rewrite. And also there is always a question of composability, like how do you interact with everything else? And if one project goes to one L2, another goes to another L2, third project goes to to a different to Solana, another project goes to Polkadot, and then like this doesn't compose, and then everything is still in Ethereum. So and yeah, so that's yeah, I don't know, like but like of course if Ethereum scaling doesn't come soon in a convenient form, we will be forced to go somewhere, but I don't know what exactly will be the chain where scaling happens. Will it be some Ethereum L2 or will it be Solana, for example?
Yeah. To sort of tack on to that, and I think, Michael really hit the nail on the head there with composability being the brutal thing when you try to do anything other than all congregate on the same L1, because you just very quickly start losing a bunch of pieces of composability and a bunch of sort of the core value of it. And I think core composability is extremely powerful and also is somehow still underutilized in DeFi right now. I think a lot of the growth potential is utilizing it better than it is right now. And you sort of start backsliding if you sort of fracture. And that's certainly been one of the biggest challenges for Serum, for Solana, and for any other layer one. I think people are underestimating how big of a challenge that's going to be for layer twos. As sort of Michael pointed out, I think people see L2s as the magical solution to this, but I think it's actually terrible on these grounds. It's sort of the whole idea is fracturing everyone between lots of only dubiously composable ecosystems.
Yeah, I think one of the things about even related to the hackathon here and ecosystem wise, the problem, for example, for Aave is that we're looking at these various different layer 2 solutions, and as Michael pointed out, it's very difficult to be the kind of a first mover to go somewhere, especially kind of if the ecosystem doesn't exist and you can't copy a whole system that is, for example, in Ethereum and just replicate it in, for example, in another blockchain or layer 2. Because kind of the idea of the ecosystem born from the roots. So basically what, if you look at something like Solana and this kind of events like hackathons and building things, the idea is actually to kind of get some ideas and build new interesting products. There might be AMMs, there might be lending protocols, there might be something else, but they have their own twist, and that makes it interesting to get the liquidity there. Projects like Aave is even more challenging because we have to follow orders. We have to follow basically the DEX liquidity, that there's secondary market prices, possibility to liquidate positions, and then of course that there's some kind of issuance, for example, stable coins and assets in general. But it's very difficult. But I think in some way I see that there doesn't need to be even a situation where one layer 2 wins everything or that's used, because I mean you could apply different level of security on different kinds of transactions. If you want the level of security and composability of Ethereum, settle as often as you want there. If you want something more high frequency, basically you could use Solana and settle transactions, for example, there, and a bunch of other things. So it really probably starts to become more ecosystem of categories. It might be where you want to trade high frequency, where you, for example, just need deep liquidity for lending or some other swaps. So I think categorization might be something that happens, but still liquidity will move from one place to another.
Tarun, what are your thoughts?
Yeah, I guess the thing I would add to this is, proof of work is a well battle-tested form of security, and it has a lot of advantages over most things, for data availability reasons, for people dropping out reasons, for kind of some partition types of problems. And I think having a decade of experience with that is the reason that the majority of stablecoin velocity is staying on proof of work, and you're not going to really see meaningful stablecoin velocity off proof of work chains for a while, until there is actually really, a decade-long CV for a proof of stake chain that really makes asset managers and those with significant funds being willing to rebalance portfolios. That being said, I think there's going to be kind of an evolution similar in weird ways, less to financial systems, but a little bit like the Linux kernel, where the Linux kernel took 20 plus years to actually do multi-threading and multi-processing correctly, to get the scheduler working, to get SMP working, to get all the request for ownership, state machines working, all the stuff that like you used to do, Anatoly, in like hardware. That type of stuff took 20 plus years for the Linux kernel, and that was why Microsoft kind of won for a long time. And I kind of see the same thing developing, where you have this kind of hierarchy of systems with different levels of security, like Stani said, kind of different, kind of homogeneous ecosystem, until all of these kind of threading and processor problems are solved, and we're just not. This is the 1970s in computing right now.
Yeah. I tend to agree. Like these systems, like just require. Like, I don't think it's going to take another 10 years, right? The next iteration usually takes half the time. So it's going to take 5 years for like these new systems to establish the same kind of like gut level security as proof of work. So I'm curious, like, with what you mentioned about stable coins and kind of like how you guys see the space, are the assets that we're going to be trading, are they going to be more native assets or like issued assets, like external stuff coming in, or is it going to be like native born things that are running on the chain? Like where do you guys see like kind of like the near term?
How would you, there are a lot of things I don't know how to classify there. Like, would you classify, Huobi token as a native ERC20 token? Let's ignore maybe they're going to come out with their own chain or something like that. Or is that like a, just some like asset thing? Like, how do you think about something which is neither a stable coin nor like a, and like really fundamental to the chain?
I would say like, because they kind of control it. I don't know. That's a good question. That's like, what's the difference between that and a governance token, right? Like, it's just a corporation called Huobi is what's controlling it. It's hard to say. Like, I don't know.
But I guess
do you see that? Yeah, go ahead.
But I guess your question was more like about something like USDC, which is an external asset, versus, I don't know, DAI, right?
USDC is obvious, right? So it's like maybe Euro, right? But
I guess both. Like we will probably see like more assets which are coming from the real world, like more currencies, like I don't know, Euro, Swiss franc, whatever, and they probably will work really well for deposits. Like, for example, there is a redeemable Korean won, which is currently not very much used, but maybe if deep liquidity is created for that, it will be used because it can be deposited with, let's say, 0 fee. And if there is a good AMM between, Korean won and USDC, maybe it will be used for Korean people to go into crypto. And I guess same applies to all fiat currencies, and also maybe, I don't know, there are also stocks, I don't know, gold, whatever. But also there are native assets. tokens for Aave, they are native assets, right? Maybe.
Oh, we need to have the pool. We need to have the pool in curve.
Yes. Right. We need to finally roll it out. That's right. And also, there are assets like staked assets. Like, for example, there are like many stakeable projects out there. I don't know, like NuCypher, Keep, LivePeer. That's only on Ethereum. Also, like Polkadot, Tezos, whatever, and I can see like staking derivatives being also some blockchain native assets. So they are not external; they are like really native to blockchain, and I can quite see how they can be useful. So both.
Yeah, actually, I want to step in on the staking derivatives point because I definitely agree that that's the way that proof of stake actually gets the money velocity that looks kind of like the money velocity associated to proof of work chains. If you think about the history of cryptocurrencies, in 2011 through 13, everything revolved around miner financing. Everyone who's a miner had a bunch of Bitcoin. They wanted to borrow against it. They wanted to sell quanto derivatives, indexed against a Bitcoin-based oracle, which is how we got BitMEX. And there was kind of the whole ecosystem of derivatives and trading really grew around miner finance, both in terms of pooling, dealing with the SPVs for pools, dealing with income sharing agreements, making the derivatives exchanges make sense. And in proof of stake, we don't see that level of financial activity amongst validators, partially because validators remind me of miners in 2010. They're kind of very unsophisticated financially, and it takes a while for the infrastructure to kind of be around so that they don't have to really, really know the devil in the details. But once you actually enable lending for validators and stakers in the same way that lenders existed for proof of work vehicles, both for pools as well as for hardware lending and hardware borrowing, you'll start to see a much higher money velocity that will require, stablecoin velocity to also be on the proof of stake chains. And whether those are native or whether those are USDC just really depends on the validators' financial needs themselves, and that remains to be seen if the validator pool is similarly averse to the BSA as miners are.
Interesting, by the way, how much, even thinking about something like native kind of, stable coins such as DAI, basically how much there is also the underlying that's derives from a custodied asset, and kind of like we actually don't have that many clean stable coins that are crypto native, which aren't at some way deriving from the underlying, let's say, dollar that it's slipping on a bank account.
I think there's just no way, almost theoretically, to do that. Like, there's no concept of a dollar on a blockchain. Any way, like, eventually it's all gonna have to bottom out into a bank account, or with a centralized custodian or an oracle onto some company that has a bank account with a centralized custodian, or you can put different intermediaries there, but I mean, it's all Coinbase in the end, sort of.
Zero knowledge tether. There's an unknown number of deposits.
There are ways to.
I wanted to clarify. I think that there's a clear distinction between a central company or corporation issuing a token like Huobi and something that is a decentralized protocol with governance. It's tied to the activities of the ecosystem. And I think that those are two different things. Huobi is an interesting kind of sits in between because they're an exchange that is clearly in the ecosystem in the broader sense, but it's not like Huobi is running on Solana, right, or Ethereum, right? I think a DAI or Aave or Balancer, protocols that are Curve, they are in the ecosystem, and that activity is part of it, right? It's kind of in the box. Do you guys see that in the box tokens as being higher value in terms of long term, or are we gonna just see kind of a mixed bag of Tesla stocks and Apple stocks and all this other stuff, or whatever, whoever takes the plunge first in the United States? I guess. Yeah, go ahead, Sam.
I was gonna say, I think that there's I think a lot of it medium term is going to be related to something from outside the ecosystem. If you think about and I think the only I think DEXs are maybe an exception to this, or various things that charge on-chain fees are like a sort of an exception to this. But sort of outside of that, it almost has to have some relation to something from outside. But if DeFi really grows a lot and a lot of companies are building on it, you might get to the sort of Bitcoin point where like now Bitcoin is money, and like you don't need to have like some number of dollars worth of Bitcoin. You can have Bitcoin and everyone sort of agrees that's like basically money, and you might get to that point for other crypto assets over time, to the extent that like more of the world's ecosystem moves on chain.
I guess this is why I still kind of think these ecosystems grow really well when they focus around validator financing needs. And so miner financing was sort of the necessity as the mother of all innovation for derivatives trading and for a lot of kind of building up the early Bitcoin financial industry. And stakers just haven't seemed to care that much yet. And like, I agree someone needs a bank account, but hopefully the bank account is the validator who needs to like convert their souls into dollars somehow, or like borrow against their future souls. Like they expect to earn 1 million souls the next year. They want to go buy some more capital to buy more souls because they're effectively leveraged long. They somehow need to go borrow against their souls, right? And like that whole circular ecosystem money velocity growth needs to somehow be there. And I think there are a lot of interesting solutions I've seen of like borrowing stable coins against your staked assets that are a staking derivative that might actually like, shrink the time window that it takes to go from like new asset to like there's a whole money velocity lending and trading ecosystem around it.
So like the point you bring up was kind of like leading to my next question, was that like in proof of work, there was like a clear need to spend a lot of money for miners to buy more hardware. In proof of stake, we don't kind of have that need, right? Like validators set up one box and it gets cheaper every year to run it, right? It doesn't even get more expensive, and there isn't a lot of point to setting up 10 boxes, despite of what people like trying to pump up full node numbers mean. Like, I think like in governance, there's some point to having some amount of participants in governance, but like, is there like limits to the size of like the governance body, like that you see in DeFi protocols? Like, do you guys like what is like the benefit of getting 10x more governance participants? Is there any, or is it like, is more always better, or is there like a point where you kind of see diminishing returns?
And does that mean engaged governance participants? Because I think that's like a big part of the question and a big part of the problem with governance today, where like, I think I personally hold governance tokens for several projects, and my level of passion, dedication, prioritization of each of those projects it differs. I cannot give 100% as a governance participant to all of them. So, that just kind of popped up when you said that for me.
I think kind of like governance is somehow like security, and somehow it's might be like quantity as well, but also it depends on like what kind of like governance in terms of like who are participating in your system, and what are their kind of like incentives and how they're aligned towards what you're doing. But somehow I think with this kind of like a proof of stake systems and where you have staking involved, it could be even on the network level, where, for example, in Aave we have. I think it's kind of like economics, because I think you can't be like passively participating and leave the decision making actively to someone else with delegation or somehow, to the extent when things are working well. And basically, I come from Finland, which is a small country in the Nordics, and people don't vote much because things are working very well. But I think if things weren't working very well, what will happen is that people could vote, but it's not the clear case. I mean, there are countries where, things are not working and you don't want to vote either. So, but the kind of point is that I think we might go to a direction where it starts to look more like a corporate governance in the sense that the underlying protocols are very economical. If you're speaking of DeFi, if you're speaking DeFi, I mean, these are practically banks running on chain. I mean, highly likely they will be governed a bit like businesses, but more in community-oriented vibe.
I guess so far we had quite an interesting experience of Curve being governed by like non-corporate way. Well, it was trying to find all whales and ask them to basically vote with regards to one or other proposal. And the hardest thing is, of course, getting the quorum. So we had like the threshold. We have a threshold of 30%, and we've been usually getting this threshold, but it was pretty hard with, let's say, when the company was having, let's say, 4% or 5% of voting power. So the rest 25% is apparently pretty hard to get. It worked. But I think what probably would make sense to do if let's say, if not go the corporate way, right? That's possible, I think, but I think it needs, well, first it probably needs needs delegation maybe. And I think the best, the most interesting one would be liquid democracy, where you, let's say, delegate your vote to someone. So when someone votes, if you don't vote, then the vote of that someone else is used. But if that guy doesn't vote, then the one who he delegates to is used as a vote, and so on. So you could have this kind of structure of votes. And
like Twitter, if I follow you and you follow Tarun, then Tarun gets all the votes.
Yeah, pretty much. But well, unless you decide to vote, then it's you who vote, not Tarun. And if I vote, it's like, yeah. So so you kind of can override this kind of back off. But if you don't vote, then the default choice is used if there is any choice at all. And that's kind of, I don't know how it works in practice. I don't think anyone implemented fully working liquid democracy on chain.
Definity. That was
Definity did.
That's their number one marketing point. Yeah. It's in their code base. I haven't voted, so I don't know.
Perfect. Should be ported to Ethereum.
I think I've always kind of thought that one of the most interesting things to come out of DeFi was this governance, like kind of making DAOs like version 2, like fix a lot of stuff and kind of have it do something. Like I think it's been like a really cool to see like how people have taken those approaches and have plugged them into protocols that do something. But I still think that like the social networking side of it, like actually building a community, is underappreciated right now. Like, do you guys think that these networks can grow to like 100 million people all in the same kind of like protocol, in the same DeFi like like in the same DeFi coin? Do you guys foresee like, you know, like Solana can handle 100 million participants to vote? Like, do you think that we can get 100 million people to go all buy the same coin outside of Bitcoin for non-speculative reasons? Go ahead, Sam.
Yeah, I think one thing I'd say is that you can't make something out of nothing with this. I think this sort of applies to like, you know, governance and participation and staking and rewards and staking derivatives and everything like that. That like, they're important scales, with how much people would otherwise care about what's going on. And like, I think we're sort of past the point where you can just like create that skeleton and be like, hey guys, we've got like staking and yield and governance and staking derivatives. It's all this one coin we just made up. Go do it. And then people are like, great, we're going to go do it. Let's see how many people get to govern the inflation of this coin with no protocol. But that if you do have something that people are otherwise starting to use, you can really amplify it with all of these things, and you can start to get a lot of adoption of the governance and everything else if there's a lot of adoption of the like sort of underlying protocol. And I think that like, one thing that sort of ties together, a lot of the well, I think like everyone on this call who has a token is that like there's something other than the token going on in the protocol. And so, I think it's one thing to say like, well, how about like, can you get a bunch of people to participate in Aave governance? And the answer is maybe. I mean, I think step one is getting a ton of people to use Aave and to be borrowing and lending with it, not for yield or rewards or for governance or staking derivatives, but because they have one asset and they want to borrow a different one instead. And then once you have that as a baseline, you have a lot of people who are invested, and then you have a lot of people who have nothing to do with Aave but start getting involved in the governance because they see all these other people who are using the protocol. And so it's like something to govern, and then you can start to like really exponentially grow all of the structure around it. I think that, the same is true of Balancer and of Curve. Like those are actual protocols that people use. And so I think like, I do think these things can be super powerful, but I also think it's like important not to put the cart before the horse here, and to like first have a thing worth governing and then try and govern it.
Right. Well, and
That's a good
also I
point.
guess, getting back to the like participation rate in governance, it's probably it is higher when the votes are contentious. Like if everyone agrees with something, obviously, or everyone disagrees, people don't even vote much. And I guess that's where delegation would be actually great. But when something is contentious, so imagine, I don't know, Aave governance voting with regards to, I don't know, raising borrow rate by factor of 5, and as well as the supply rate. So borrowers are kind of totally against that, suppliers are totally for that, and they are kind of fighting each other or something. Well, I don't know if it's a good example, but yeah. So I guess that's where like the people's vote matters most.
And I have to agree with Michael on this, that people maybe stress too much about the, like how many votes are showing up, and I think some of the project might stress it out also because, you kind of want to know or understand like what kind of mandate, like how extended mandate you need to actually pass a decision. Because let's say if you have a big change in the protocol, is it sufficient that you pass it, let's say with 0.5% or percent quorum, or let's say 4, and all these kind of like things, and so some of the protocols, they have very high the quorum or the voting threshold, and I think it's just kind of like as Michael said, that if there's something super controversial, people will show up and there's campaigning, but if it's something like, let's say, it could be in Aave just changing the collateral factor by 5% or liquidation incentives, those are things that probably like not many will come, but the controversial stuff, that's a different story, and people probably will fight for this.
And one thing about that, I think that maybe sometimes needs to be thought of before building these things is sort of what you mean by like fast governance and slow governance. Like changing a collateral factor because liquidators can't liquidate because there's a market crash, that's like a fast vote, right? That's not like something that you even need to really go through like the 2-week process of like, hey, we want to redistribute tokens to certain people, because that's like a very qualitative judgment call type of So I think in some ways, like, yeah, liquid democracy is one of these angles that tries to like not force the users to have to think about this, but yeah, there is definitely a bit of cart before the horse, and it is kind of sad in some ways to see a lot of the stuff that was invented in 2017 and 16 kind of be completely useless for proof of stake, because no one in proof of stake ever wants to make any decisions. Everyone's super conservative, and DeFi is the only place that like all of that research is getting applied.
In that sense, like there was a kind of one of the top questions is about flash loans and those kinds of attacks. Do you think that people are gonna, like, how far away are we from like governance attack vectors, where like people try to game a particular protocol to cause something to happen for their own benefit? Or are you guys already seeing this?
We have a lot of discussion on this. I think there's actually, this is a kind of like a interesting point, because I think it was like 50,000 MKR, or if I correctly remember, that you need to actually activate the what do you call it, like emergency shutdown in the MakerDAO system, and also kind of like this borrowing for voting. It's a big question now, especially if you can vote with, in the future, let's say with A tokens or C tokens and whatnot. It becomes very challenging. But the question also is, for me, that let's say borrowing assets to affect into the governance in let's say in good governance that has been seen in corporate governance. I mean, as a kind of like a not so good practice in that sense. But there's many ways to mitigate various things. But here in on-chain ecosystem, practically there is less things. So you need to design systems pretty damn well that kind of like you mitigate governance attacks. But the issue, of course, is that we never know how big this opportunity is. So let's say if you have to lock your tokens to vote, kind of like for how long a period you're able to take that locking risk by borrowing a lot of assets and making a bigger kind of a profit from that. And I think there isn't clear, yes or no. What I've been following in the Aave governance forum, it's pretty much like there's sort of kind of like arguments that governance tokens shouldn't be borrowed, but then again, like they're assets as any assets, and comparable to shares, and why not? So it's really difficult to say. And I think what works very well in DeFi is being conservative, especially times like this. And this is practically the reason that every governance token we have listed in Aave has been practically without the capability of borrowing at the moment.
Yeah, well, I guess it's probably better to include the protections on the protocol which uses the governance token itself. Like if you can take your token, vote, and leave, that's probably pretty bad, because you could manipulate. But even if not, like for example, like on Curview, we kind of vote lock tokens, so there you really commit for a long time, and that's good. But I can quite see that for some protocols it is possible to even, let's say, if you look for some like if you look for a protocol where which struggles to get a quorum, and the quorum requirement is low, at the same time with low market cap, then it could be cheap enough to just buy tokens, do something bad, and forget about those tokens. So even if you didn't like borrow them, even if you bought them, it could be like enough of an incentive. Well, the good thing is that all the voting takes time. So if there is a malicious vote, it will be visible that it's malicious, and people who use the protocol will have time to leave. But basically, I guess the vulnerability here is not so much making an exploit for money, but more like making an exploit, like having users of the protocol to either leave or be vulnerable. And obviously, rational users will leave, and this will destroy the protocol. So that's kind of what the governance attacks open you up to. And I guess another mitigation of the attacks is not allowing to change the code of the protocol arbitrarily by governance. Like, I don't think governance is ready for arbitrary code changes. Of course, like when you have the company and the team owning like all the governance tokens, then it doesn't really, it's not distinguished from the company owning that protocol. And then of course they can change the code, but then it's kind of it's also not well, not very safe. Like you really need to trust that company to do that. But when the protocol is truly decentralized, then you are kind of open to all these sorts of governance attacks. And if you can do arbitrary code changes with all the state which holds the money, then I guess it's I wouldn't be comfortable with that.
So it sounds like this, I mean, I think a lot of what's been said is sort of potentially in support of the case for crypto projects really taking their time. And it differs from project to project, but really taking their time before like making that step to full decentralization because of all of the unknown unknowns and how early we are in decentralized governance right now. I think for some projects, it can make sense, of course, to, you know, be feature complete and go, you know, fully decentralized from day one. But I think for other projects, you know, it probably makes a lot of sense to really, you know, take time and treat that as an incremental process.
Yeah, or it's possible to solve it by simply the token distribution. So let's say initial tokens are held by the project, I don't know, investors, whatever, and then the project is centralized at the beginning, although governed by tokens, but then it's gradually transitioning to decentralization by just the way of token distribution.
Yeah.
So we're almost like we have 5 minutes left. I kind of wanted to ask you guys, like, you know, what does this look like 5 years from now? Like, what are we working towards? Like, like 5 years is like infinity in crypto, right? Like, well, you know, what do you guys think will actually change, like, by this? I have a hard time thinking beyond six weeks from now because that's kind of effectively one sprint. So beyond that, it's like a black hole. Like anything could happen.
Oh. Most traditional banks being obsolete. Most of world finance running on chain. With this pace, that's not impossible. Well, I would say 10 years though.
Like, what does that mean? Do I actually do I have an ATM card that spits out dollars that's connected to like Aave or like?
Well, I mean, I guess most probably you can interact with Aave or Curve directly, or you can go to your traditional bank, which will do nothing else than interacting with Aave or Curve or Balancer. And it will be just banks will be front faces to DeFi.
Yeah, I'd also like share the vision that practically, you know, this is so unstoppable and it's already too obvious. So it's very difficult to, you know, put the reverse gear on this technology and basically create something more controllable and less efficient. And I think the only way to kind of like for the traditional finance to, you know, keep up with this is practically join the ecosystem one way or another and provide the access. And the thing, as Michael also pointed out that what they have is the brands and user bases that they can connect, and probably they will become the front end DeFi shops for the DeFi protocols. And one thing I can predict that if this happens, these DeFi protocols and all of these networks that are now, they might become substantially large, and not just by the extent that they are kind of like eating whatever is out there, but because it's so efficient, and it's so efficient to build things that we never have seen anything like this before. Anyone can just deploy code from any part of the world and create the next Curve or Aave and whatnot. And this is like the beauty, you can create very specialized products that will be accessible for wide demographic.
I guess I can also tell a pretty dark perspective, which Anatoly will like, and this is that in 5 years, one transaction on Ethereum will cost $100,000, and only banks will be able to transact on DeFi. So they will introduce KYC and everything.
So, I mean, but to be fair, validators' identities are known, so it's already a form of KYC and proof of stake. But
they don't have to be.
I mean, they're still registering to the network, and I can measure latency to their blocks. But I think I'll take a different tact. I think everyone else wants to have the Stripe version DeFi narrative, which I think is that's the most appealing one. But I'm personally more interested in the privacy improvements over the next 5 years. I really think those are quite key to actually getting DeFi in the hands of more traditional investors. And right now, thanks to the Moore's law that we're having, in hardware, there's no more Moore's law. We're done. Scaling's over. Go home. But in zero knowledge proof land, the Moore's law is actually quite amazing right now. And I think it's quite hard to see if you're not really at the conferences, reading papers, looking at the performance numbers and stuff like that. But since the first sort of ZK Snark paper in 2012, we're about 1 trillion times larger in terms of the compute capacity we can handle in a proof. And I think generating private DeFi primitives is the future to really getting to this 100 million voter world.
And I think scaling is just super important. I think in any world that really matters, scaling matters way more than it gets credit for. I think people often think of scaling as needing to get another factor of 100, so that AMMs on Ethereum are useful with current adoption. That's with 1,000 users. If you want 1 billion users, you need another 3 orders of magnitude. And if you want to have something that has powerful applications, you're going to need another 2 above that. And so I think realistically speaking, in order for DeFi to really get huge, you need a factor of 1 million above Ethereum in terms of throughput. And I think it's just I wouldn't quite say worth dismissing out of hand any chain that doesn't have a roadmap to get there, but I actually do legitimately believe a sort of a weaker version of that. As far as the potential for it to become huge, now a chain can a chain or an ecosystem can absolutely have the potential to become moderately sized without that, right? If your goal is to have DeFi be a $100 billion sector, that doesn't need a factor of 1 million. That needs a factor of 1,000 or something. And that would still be pretty cool. That would be a lot more than we have now. And that's starting to approach Bitcoin levels, or current Bitcoin levels. But if you're thinking that it's going to be a lot bigger than that, just need to keep adding orders of magnitude. And it's not you need infinity. There's sort of how many people there are in the world. How much data the internet consumes. How much data NASDAQ traces through. You can sort of ballpark these numbers. I think it's just incredibly important, and that people underestimate how much we need more than just a bit more throughput in order to really scale. And again, we don't need it all tomorrow. We need it all in 10 years, but like, you better have a roadmap for getting there in 10 years, and you better have a lot more than we have now tomorrow.
I want to add one other thing, which is that in my mind, the only way to actually scale in the long run is a lot of new cryptographic primitives. The compression from a lot of the new zero knowledge proof schemes, as well as the level of interactivity going down, means that you're getting much closer to Bitcoin-like experiences on smart contracts in 5 to 10 years, with proof sizes that are 256 bytes or 1024 bytes. So that's the way you get to 1 million times scaling. I don't think it's coming from like hardware or sorry, Anatoly.
We'll see.
Yeah, I don't know. You can get like a surprising number of orders of magnitude right now if you really try.
Yep.
I don't know if surprising, but you need a bunch.
I guess better to combine everything, and that's where you get it.
There's a lot of sand to organize. There's a lot of sand to organize. Surprising amount of sand. But what do you think, Jeremy?
Yeah, I would throw in maybe like a macro perspective, just more zoomed out, where I think that like building in the space will continuously grow, sort of maybe in a more like linear fashion, whereas adoption and entry into the market or into the ecosystem of new entrants will kind of continue to follow sort of a cyclical pattern, where it experiences periods of booms and periods of slowing down, and those cycles might kind of continue to tighten in terms of like the frequency and the length of those cycles.
I kind of tend to agree with all of you guys, even Tarun, in terms of like what the future holds. Just in terms of my opinions on scaling or something like that, is like somebody really smart told me to do all the cryptography at the last possible moment, because the research there basically changes every 2 months.
But it's like hardware in the 80s, right? It's like people didn't get tenure because they weren't studying the right hardware that was doubling every 18 months.
Yeah. So that like, I kind of think that that's just kind of part of how the general ecosystem matures. I would say that like what I'm excited about is kind of breaking out of the box a little bit, like having more users than just like MetaMask users in the space. And not like that there's like another version of MetaMask with its own set, like just my mom asked me about Bitcoin, not because I'm working on a crypto startup, but because the amount of like airdrops the federal government in the US is giving her like is scaring her, because it reminds her of the Soviet Union. And like that's what freaked her out. And like those kinds of users are like out there. And I think that's just kind of like the base kind of fear approach, but there's opportunities outside of store value, which is I think the simplest version of DeFi. Like I have a savings account to like get people in and get them to understand that there's, less fees, like less middlemen trying to screw you, and kind of more open and transparent systems that are like not like trying to like scam every month $12 out of your account for some random reason or something like that. Like that to me, I think is like the more exciting part is like getting people to understand that there's like a difference. Once they understand it, then they will like jump over hoops to learn, how to deal with with the key pairs. It's not that hard, right? They just have to have like a need to do it. So
I think also the size of the hoops that they would need to jump through will continue to shrink. I think like the UX needs to continue to improve. And of course, it's sort of basic foundational things like throughput and fees, those things coming into the right place to essentially create like a very comfortable bridge from, CeFi into DeFi, where it actually doesn't feel like you're crossing a bridge that much. I think that's an important thing that'll happen.
Cool. Well, I think we're like basically over time, unless you guys want to hang out. But I'm sure you're all busy and have like companies to run, like or 3 companies to run, and like tons of other stuff to do. It's been really awesome to talk to you folks. I hope in 5 years we get a chance to grab a beer together somewhere.
Hopefully
I hope
that-
so.
Yeah, definitely.
Yep.
Sounds good.
Cool.